Okay, great. John has a question here. You talk about not trading around the 9:30 open. Is the reason the same as the suicide bar at the close you talked about?
Absolutely. Great question, John. Yeah. Look, you've got all that. What happens is there's a lot of things that happen at the open. There's people from the night before that got margin calls. Think about all the people. Hopefully, nobody in this room has been in that perspective or that situation before, but unfortunately, it happens all too often. A stock trader or whatever has been going ahead and trading, and they've gone ahead and they've fallen below their margin requirements. They get a call from the broker, and then they say, you know what, broker, I don't have more money to add to this position. Broker liquidates them at the open the next morning. So you have that. You have different funds that are going ahead and sloshing huge dollars in and out, very early on in the day. There's just so much that could happen right there at the open. All the bets that are placed, with huge volume at the open, it's too uncertain. And when you're on the right side of the trade, it's a beautiful thing. When you're on the wrong side of the market forces that be, it's not a beautiful thing. And so it's too much Vegas for me. And so yeah, I like to avoid those first several seconds after the open. Todd?
Okay, Tom has a question here. On a day like 9:25, where you have a nice move up and a pull back to the 20, any setups for when the price hits the 20?
Okay, I should clear the screen off first here. Give me 1 second. Now, Tom, I assume what you're referring to is like right here? Did we get a yes on that?
Yes.
Okay. All right. The thing you have to go ahead and understand here is that basically the best way to go ahead and trade this, first of all, what you would have had to have done with this, Tom, is go ahead and not focus on the 2-bar setup, because you would have been the rule would have been denied right here on the 2-bar setup. Okay, because you closed about 50% off the high, so that negates the conservative 2-bar rule. Okay, so what that means is is there a nice setup here? Yeah, there is a nice setup here, but what that involved was going ahead and waiting until you pull back. And as we talked about, I told you there was actually 2 strategies. One I showed you a little bit ago, which was right at the close of this bar, not when it got up to here, but at the close of the bar, going ahead and scaling in a contract, scaling in a second contract between the 3 and the 5 period, speed lines, and then scaling in more of the contracts as they went ahead and hit the rising 20-period moving average. That's really the setup, because what you're doing is the setup itself is that you've gone ahead and had multiple thrust bars. So this would be the effect. If you think about this, guys, for a minute now, this is exactly what I've been warning about the suicide bar. Okay, look what happened. The 20-period moving average was trending down here. I'm sure everybody sees that. It's trending down. So if you were going short here, all of a sudden you get the first bar closes right at, all right? Second bar closes above. You had 2 huge bars with a key reversal up going, against you here. Something has fundamentally changed, okay? And sure enough, then you get a third bar that goes ahead and thrusts into this direction. And then the 20-period moving average changes. This is exactly the kind of thing I was talking about the fundamental change and a shift of what's going on, which is why the suicide bar clause, is in my book. So what happens is then you say, okay, I believe the trend has changed now to the upside based on what I just saw here, how the shorts just got annihilated and the 20 periods now start to turn up, okay? So the first setup would be aggressively buying on a 6 contract trade, buying a contract here, buying a contract, between the speed lines here, and then, if you're going to trade all 6 contracts, that's your normal size, buying the other 4 down right when it touches the 20-period moving average, okay? That's, your first option. The second option is going ahead and identifying all this, but being more conservative and saying, I'm going to go ahead and put in my contracts that I'm willing to trade on this trade, but not until it comes down and touches the 20-period moving average. Okay, so those were the two setups that were available on this, from my perspective. Now, there was something else that came in. This is kind of unusual, so I'm kind of hesitant to bring it up, but you did get a secondary key reversal up where this bar shadowed the first bar and made an outside bar with a key reversal up right before, the next huge move. But those don't happen as often. I did kind of share that in my my fishhook presentation, though, with the where the fish hooks, where you're looking for it to go down, and then it goes first on the next bar, and then goes and comes back up. But I like to see those. If and maybe some of you kind of gathered that, I like to see key reversals up, where we make the move down lower, gets everybody short, and then all of a sudden it turns around and goes back up. Same thing, I like to see, because what we're seeing here in English is people are getting hurt. They got themselves trapped on the wrong side of the trade. Now the move's beginning, and so I like to get in near the close of bars like this, because usually what will happen is, if I'm not in a trade, that is, because if I'm not in a trade, usually you can just feel the pain of people getting trapped, where the bars go down lower. You see that over and over and time again, where that kind of thing happens, where they get trapped into a position and now they've got to get out. Well, if you get in, at the close of the bar, or a quarter tick above the open of that bar, then you can be there to ride their pain. Okay, so but those were focusing on the other two parts. The real setups here, Tom, were where you go ahead and you had the thrust, you had the breakout, you had the suicide bar, bringing us back above to make it a rising 20-period moving average, and then you go ahead and you scale in at the prescribed areas, or you wait till everything gets down to the 20-period moving average, and then you go in the size that you feel comfortable with. Todd?
Okay, well, that appears to be all the questions for this section, unless anybody wants to.
Well, we've been going for almost 3 hours. Let's just go ahead and let me just take a second here to get some water and another throat lozenge, and
Sure.
let's get right back into it, because I do got those other obligations today. So
Sure.
let's just take just a quick 1-minute break here. Then I'm not even going to pause the video just to grab some water and stuff. Okay. Okay, Todd, I'm ready when everybody else is here. Okay, Todd, are you back?
Yeah, and we have one quick question from Joe. Do you use price action to tell if the trend is changing or losing momentum?
Yes. And Joe, the price action is exactly what we talked about there. Let me go ahead and actually open up a new chart real quickly for that question. So what I'm looking at here, get my little magic orb. It's what we've been talking about, the price action itself. Here I'm expecting the market to go down, okay? Or let's just use, I guess we can go back to Tom's example, if kind of keep for consistency's sake. I'm looking for the market to go down, and the 20-period moving average has been rolling down. If we get price action here in key reversals and outside bars, that's exactly what they are. And remember, this is unclear. There's multiple definitions of key reversals. Let's go with my definition here. So you have a bar here. Let's say this is the open, this is the close. Okay, so a key reversal down is where the high goes higher than the previous bar, but the close goes ahead and closes below. That's a key reversal down, with a key reversal up being just the opposite of that. Great chicken scratches here, guys. So the key reversal up going in and be where the low makes a lower low, but then the close ends up closing above the previous bar. So that's, the key. So here we see Rob's definition right here of a key reversal up. Here's my definition of a key reversal up. Here's my definition of a key reversal up. Here's my definition of a key reversal up. And of course then, here's my definition of key reversal down. I'm just kind of trying to throw a couple of those out at you there. So here was, again, same thing, key reversal down. So what we're doing here is, that's all price action, okay? That's all price action, and has nothing to do with, where's my 20-period moving average? Is it rising, and so on and so forth. But so key reversal up, price action is very important to me. I've tried to get people to focus on key reversals up and key reversals down, my definition of them. There's some other definitions that are far more conservative, where actually, because the other key reversal up, what a lot of the people like to see is the whole bar has to be engulfing. It's like this bar here can't just be up to here and be a close. The whole thing has to go ahead and basically be engulfed and closed. Okay, that's one of the definitions other people use. As you guys know, I like to tweak my own stuff. It's not proprietary. I share it with you openly. I'm not selling any of this stuff. I'm just going in and sharing with you that that's my version. So but that's all price action. So yes, when I'm in a trend, I'm looking for a short, and all of a sudden I start seeing buy signals like a key reversal up come in, secondary agreement where I have like the suicide bar above my 20-period moving average. That's all price action. And so yes, I definitely use price action in my trading decisions. Todd?
Okay, and that has spawned a few extra questions here. So Tom has a question. Should volume always be associated with key reversals, and should the key reversal bar be red on an uptrend and green on at the bottom of a downtrend?
Okay, you know what? Let me go ahead. First of all, let me just put volume on here. To answer the question, first of all, ideally, key reversals usually do come with more volume, because what they're usually coming near the end of a move, and so you're getting all the Johnny-come-latelys and the Jane-come-latelys to the party who are going ahead and buy at a top or buy at a bottom, basically, okay? So usually, yes, these will be associated with heavier volume. If they're not associated with heavier volume, will that immediately in itself eliminate me from taking the trade? No, because the psychology is usually still there where people are getting trapped in on the long side of the trade or the wrong side of the trade. But the best capitulation is where, you do end up getting more volume into the key reversal up. That would be your highest probability trade versus a lighter volume trade. So if you're a more conservative trader, wait till you got more volume in your key reversal bar than the previous bar. If it's less volume, then ask yourself how risky are you feeling that day. But the higher probability ones will be with higher volume on the key reversal. What was the other part of the question, Todd?
I just accidentally erased it, but it was something in regards to on a key reversal down. Should that be I believe, a red bar at the top, and then
yes.
vice versa for?
Yes. Okay. Absolutely. You're going to want, a key reversal down. You're going to want to go ahead and have it be a red bar, because what that is you're going to want to go ahead and have the close below the open, okay, is what you really want to see happen on that. So because what you're doing is you're basically bringing in more buyers into this. Okay, it opens up, you get more buyers in, but then it's so weak in the end that it closes down below that open and below the previous close. Same thing here. What's happening is it's faking people in, it's getting them sucked into this, but then all the volume comes back in. It's so strong, closes all the way back up, well above the open, so that should be a green bar. So yes, green bar for key reversal up, red bar for key reversal down. Those are the more optimum trades. Todd?
Okay, excuse me, Gabriel has a question. Would there be any difference if the decisions were made using the S&P cash index instead of the E-mini chart? What is the actual difference between these two charts?
Well, let's go ahead and show that for you. The cash chart, didn't go ahead and work. Give me 1 second here. You will have the same key reversals on the daily chart. Generally, the daily chart, or sorry, the cash chart should go ahead and give you the same key reversals. In fact, I'm actually seeing a couple of ones that were even more clear, like this key reversal down was actually clearer on the cash, okay? But you should go ahead and have the very, very similar signals. So for some reason, if you're not able to look at the S&P chart, or if you're not a S&P futures trader, which is perfectly fine. I really haven't said that. I didn't really even say that in yesterday's webinar either. I know many, excuse me, I know many of you are stock traders, and there's nothing wrong with that whatsoever. Remember, I told you guys back when I did my stock trading, I used to actually use the S&P futures as my guide, which is why I eventually switched to them years later, because I wasn't crazy anymore. I mean, let's be honest about it. How many of you each night are going ahead and looking at countless stock charts each night looking for just the right setup the next day? I was literally going through hundreds of stock charts, especially back in the 90s. These days they got a lot of scanning programs out there. TradeStation was pretty good, especially towards the late 90s, in developing tools to help you scan through your charts for different types of patterns and stuff. But by that time I was so frustrated with the whole process of looking at hundreds of charts a night. The good news is it made me one heck of a chart reader. The bad news is I spent a lot of time away from my son, and so that's why I eventually moved to the S&Ps, and that was started with the Dow futures and then the S&Ps, was because I was looking at them anyways. So to that point, Gabriel, absolutely, you're very welcome to go ahead and use the cash index, or like the Dow, same thing. If you're trading stocks, or you're trading a spider or some other sort of ETF, by all means use this chart. You'll get very good signals as well. Todd?
Okay, that looks like we're done with our questions for that section. We'll move on to the market events, news, trading psychology, and basically the miscellaneous section. We have a few questions here. First one is, if you don't mind me asking, How long did it take for you to become profitable?
Well, that's a loaded question because really profitability came and went, especially in the early '90s. Here's what I'll go ahead and I'll say that I became most profitable when I switched to futures. Now, that's not a recommendation for anybody else to switch to futures, but the reality is, years ago when I switched to futures, because I think in part it was ironically what we were just talking about here a few moments ago was the fact that we went ahead and we're going ahead and looking at every night. I was looking at different charts. I was looking at what were people talking about, in on news wires, and what was the flavor of the day? Was it Cisco? Was it Amgen? Was it Xilinx? And geez, some of the stocks I was trading aren't even around anymore. And or was it Oracle or whatever, 3Com also it brings back all sorts of memories from way back in the day. But what was happening was, I didn't get to know those individual stocks. And if you're an individual stock trader and you're not trading just 2 or 3 stocks and that's all you trade, you don't really get to know the personalities of those stocks. So first of all, I was a junior technical analyst in the first place. I was a junior market participant, and I was also trading like the Wild West, something new every day. I went ahead and became most profitable when I switched to trading 1 or 2 instruments consistently. So I suspect there are probably a lot more people out there that if they just trade one ETF or one futures or one stock for that matter, where they get to know its personality, they would probably do better than trading several. So that's when I became most profitable, switching to 1 or 2 instruments that I grew to know and love. Todd?
And I do agree with that. Just that before futures, I was doing mainly options, and pretty much the same thing. It's a lot more consistent, and it's like you get to know your baby type of thing. Okay, the next question here is: was there a moment where you realized that you quote unquote got it, meaning that I know I can support my family on my trading income?
Well, as I think back, the moment of got it. Well, I think it was a series of things. I'd had a long run of successes, making a lot of good calls, frustrated with the corporate world. Even though I was pretty young to the corporate world as was, but my personality just wasn't really much for I guess the way people talk to people in the corporate world sometimes. So when I first left the corporate world, or when I first guess I thought I got it, I had a long sense of profitability and just frustration, and feeling my youth was that, well, no matter what, if I got to go back and get a job or something, I can, and so I took that chance. But in part, profitability was key at that time. Todd? Oh, I'm sorry. So I want to say one more thing on that. I would
Sure.
not, you know, I would not go ahead and recommend anybody go ahead, family man or woman or not, go ahead and this is just my thoughts on the matter, but everybody's frustrated with their jobs. Everybody wants to make millions of dollars in trading. Everybody wants to go ahead and work for themselves. I completely understand that, obviously, but if you're not consistently profitable, if you haven't found your niche and your groove yet, my recommendation to you would be to keep employment, or have your spouse make sure your spouse is maintaining employment that can support your bills and everything else, and so on and so forth. I don't think if you leave the trading world, or if you leave your full-time job in the regular world, and then you go ahead and you fail at this, it's very hard to go ahead and then go back into the regular business community and say, Well, my experience consists of all this great stuff I did many years ago, and then I was a day trader. Day traders and short-term traders and that have a negative perception about them as is in the world. I mean, come on, look, you got the government trying to block people from shorting because all the world's ills right now are because of shorts out there. Can you believe it? I mean, frankly, it's ludicrous, and I'm not making a political statement, but I think it's very ill-advised to blame, traders and just the people who short stocks for all the world's ills. That's just madness. CEOs and governments got us into the trouble we're in, not, Tom over there in Indiana or Joe over in the UK. Those weren't the people that got our economies into the, trouble. So, I guess that's my 2 cents worth. But with that being said, there's this negative perception about traders and stuff. So it'd be very hard to break into the job community if things don't work out. So maybe keeping a job, working at night, or if you're in Europe, it's even better. You can work during the day and trade at night. That's a great gig. So just think about that. Don't do anything rash and suddenly jump into quitting your job just to be a trader. Make sure you're consistently profitable and that you have backup contingency plans, and make sure you honor your responsibilities to your family first. Todd?
Yeah, definitely. For me personally, and I know for you as well, Robert, family definitely comes first. So you always have to keep that in mind. Next question is, I seem to have trouble losing my it would have been funny if they had it the other way around. Losing my long/short bias for the day when you. Let me start this up again. I've seemed to have trouble losing my long/short bias for the day. When do you say this trend is reversing and it's time to change my bias? So basically, I think if he has a bias to one direction and then the market switches around on him, he has a hard time agreeing with that or following that.
You know what? Absolutely. And boy, that's a great point. And I've talked about that. And you know who? And maybe the person asked this question is. I didn't really look at the questions so much. I forwarded them on because I knew we'd be addressing them here. I can go back and look, but a lot of the people that have that problem are people that are very, very successful in their day jobs, and or their previous former lives or whatever. I completely understand that because, we have a bias, we have an opinion, and come on, how many times in our personal lives it's like, nope, that's the way it is. It doesn't matter. I don't care. I'm right. You know what I'm saying? What you have to remember, all kidding aside, though, is only the market is right. Our opinions of the market, mean very little. Only the market is right. And what I would say to you is this. Do something this simple. If your bias was to the downside for the day and the 20-period moving average flattens out or turns up, you have to sit there and say, okay, maybe I'm wrong on the day. Okay? And, as we look right here, this actually getting to this trade, okay, your bias is to the downside. You're coming in from Friday, going into overnight trade, or coming from Thursday, going into overnight trade. Your bias is to the sell side. Great. Guess what? So's mine, everybody. You know what? There's nothing wrong with that whatsoever. The overall macro trend is to the downside. But when the 20-period moving average starts to flatten out, you got to say, you know what? Maybe the trend might be changing. Okay? Then you see it starts to go back down again. Okay, no problem. This is a confirmation of my trend. But then you get the suicide bar that comes back up and takes you out and starts to change that trend, you have to sit there. You have to. If you're going to be long for this world of trading, you have to sit there and trade on the right side of the trend. You have to mentally go ahead and change your opinion of the market and say, you know what, it doesn't matter. I don't care that I was wrong. That's what you got to get to. The people that, and perhaps you as the student that's asking this question, right now you care. Because so many people, I mean, come on, look at my YouTube videos and that, people posting comments or coming into the real-time chat room. How many people are just like, where do you think it's going today? Where do you think it's going today? Okay, come on, guys and ladies, listen to me here. It doesn't matter. I can't say that enough. It doesn't matter where I think it's going to go because that doesn't put money in your pocket. Now, if I go ahead and I happen to go ahead and give great analysis and it goes ahead and happens to go that way, great. Well, okay. Once again, we proved why I'm able to go ahead and teach some people this stuff. But as far as putting money in your pocket, what puts money in your pocket is which way is it really going and which way are you really trading. So you know what? Do what I do all the time. I sit there and say, okay, well, thought it was going down, and I see that it's reversing here. 20-period move is turning up. Something's fundamentally changing with the overall position on the day. Big deal. Does that pay my bills that I was wrong? Does it pay my bills that I was right? No. What pays my bills is that I properly identify the trend changing and just say, okay, that's what it is. Okay, no big deal. It's gone from a downside trading bias to an upside bias. So I acknowledge it and just humbly accept it and say the market's making a change. I'm going to make a change too, and I'm going to start trading long. Same thing right here. The market's been going up. The market starts to have a couple of bars going, starting to, morph to a sell side bias. You sit there and you're saying, well, no, it's going up. I called it at the beginning of this day. I was right the rest of the day. And so suddenly, because you were right and a genius the rest of the day, that means you got to be right the rest of the day in an overnight trade? Absolutely not. Okay, so I can't emphasize that enough, and that's why I'm being tough on this question, because there are so many people that are so smart. They're just absolutely geniuses in some cases in their day jobs and in their life, and they're successful in life and love and happiness. But then they come to the markets and they want to tell the markets, here's what I want to see happen. This is what's got to happen. In the markets, it's the one place you've got to sit there and humbly accept I was not right, or I may have been right earlier in the day when I said it was going up, but I wasn't right that it was going to stay like this for the next 24 hours or the next week or whatever. I identify that the trend is changing. I see the 20-period moving average flattening out here. Something is changing. I see the 20-period moving average rolling over. Something is fundamentally changing here with the dynamic of the trend, okay? So the first thing you got to do is say, in everything else in the world, if I want to be stubborn and I'm going to be right about it, fine, that's fine. But in the markets, you got to just sit there and let it roll off your back. Believe me, I take a lot of stuff personally in life. But when it comes to trading, if the market goes ahead and makes a change, I go ahead and I just sit there and say, okay, great. It's changed fundamentally. We're back to a long side bias. I don't sit there, oh, it's got to go back down. I said it's going down for the day. I told students it's going down for the day or whatever. It doesn't matter because it doesn't. Unfortunately, some people want to come into a chat room and cling on this I just don't understand it anymore. I understand it back in the day in the early 90s when I was looking for somebody to feed me every day and just tell me which way it's going to go so I could just take a trade and blame them when I was wrong. But now, you got nobody to blame but yourself.